To discuss the latest inflation data is Daniel Lacalle, chief economist at Tressis and author of the book Freedom or Equality. Good to see you again, Daniel. So you've said many times on the program that tariffs don't feed to consumer prices. So do you consider this latest inflation report proof of that, with the consumer price index reading coming in slightly cooler than expected?
Hi, Don. I completely agree. I mean, the latest figures show that there is absolutely no impact on any of the items of tariffs allegedly creating inflationary pressures. What we have seen in the July figures is very interesting, because if you compare it with the September or October figures, both on a core level, at each of the items from food at home to energy to all the different parts that make the average basket of any citizen, what we can see is that there is absolutely zero inflationary impact from tariffs. In fact, what is absolutely evident in the figures is that inflation in July is actually a lot cooler than what it was in September or October, when the Federal Reserve was stating that inflation was at a sufficiently low level to cut rates. So again, it's evidence that tariffs are not feeding into inflation. It's evidence that inflation is under control. Furthermore, it's also important to see how items such as energy and such as gas and utilities, all of those are improving.
Yeah, I mean, just building on what you said, Daniel, some of the items are actually lower. The inflation actually slowed in the CPI report. But can you break down the numbers for us for core inflation? July's reading rose apparently at its fastest annual pace in 5 months. Can you break it down for us?
Well, actually, if you think about it, the core inflation at 0.3% was actually in line with what we saw in terms of core inflation in September or October. In fact, core inflation is lower than in September or October on an annualized level. What matters for people that try to use the fear mongering on tariffs is the month-on-month inflation. Obviously, the annualized inflation includes a lot of months of the previous administration's work and certainly policies. No? So what we need to understand, for example, is that food at home is down, that prices of energy, of utilities, electricity, so many of the items that we purchase on a day-to-day basis are actually down on a month-on-month basis. And if we look at core prices month on month, every month since the beginning of what I call the tariff tantrum, the evidence is that inflation is actually below the pre-tariff period average.
Okay, can we also talk about the Federal Reserve? Because Jerome Powell has previously said that the reason why he's not cutting rates, or rather delaying the rate cuts, is because he's worried that inflation, or rather tariffs, could fuel inflation. What are your thoughts on that? Does central bank policy, monetary policy, have an impact on whether tariffs increase prices and whether it can lower those prices?
The Federal Reserve cannot say on the one hand that they're data dependent and on the other hand not be data dependent. That is, the constant messages of contradiction coming from the Federal Reserve are unacceptable. First, if they were waiting for the impact of tariffs on inflation, by now they have 6 consecutive months in which the figures show that there is no inflationary pressure. Second, if they are following their objectives and their targets and their mandate, they should be looking at employment and they should be looking at inflation. None of those suggest that they need to hold rates. In fact, with the latest revisions of employment figures, what has been proven is that they had to cut rates faster earlier. Although the job creation has been robust in the private sector and has been strong in nationals and US born citizens, all of those elements are not enough to make small businesses hire faster. And definitely, small businesses and families are suffering from a completely erroneous monetary policy coming from the Federal Reserve. The Federal Reserve actually publishes a beige book every month in which they show how the economy is doing. Well, if you read the beige book, they should have reduced rates, they should have cut rates much faster and earlier.
Okay, which of the two mandates that the Federal Reserve focuses on, which one of those two should they put a heavier weight on right now, currently? Employment or price stability?
Well, obviously, they're not putting any weight on any of them. They're putting an enormous weight on what they believe may happen if their models, which have always been wrong, let's remember that, if their models worked. The problem with the Federal Reserve is that they have 24,000 people holding on to the results of models that failed in 2021 and are failing in 2025. So, if we look at their mandate is full employment and price stability. So it makes no sense to keep rates untouched the way that they're doing, and it makes an enormous harm on businesses and families when the employment figures have been revised the way that they have. And the beige book itself was already mentioning the slowdown in job creation, and at the same time, inflationary pressures are non existent. Therefore, the Federal Reserve is actually not complying with any of its mandates, and it's not being data dependent. The Federal Reserve needs to cut rates because rates right now are higher than where they would be if they were floating freely instead of being imposed by a central bank.
So essentially, you're saying the current benchmark interest rate from the Fed is too restrictive, with it being over 4% and inflation averaging around 2 to 3%.
Absolutely. And if you look at what the Federal Reserve members say themselves, they admit that interest rates right now are above the neutral rate. When interest rates are above the neutral rate, it's unnecessarily penalizing small businesses and families in particular. And let's remember that the Fed's misguided policies hurt families on the way of expansion by creating an enormous level of inflation. And now that they are stubbornly waiting for the models to work, they are actually penalizing families and businesses with elevated rates. This is not acceptable because we must remember that the difference of 50 basis points, 100 basis points in the Fed funds rate is an enormous difference on a mortgage or on a credit card loan.
Okay, just one last question, and I noticed this when looking at the core CPI numbers. It seems like it was services that was driving the inflation, the core inflation. Do you think that's going to make it core inflation harder to come down? Is services inflation stickier than goods inflation?
No, I think that's simply the year-on-year effect. We had a level of services inflation in July last year that looked allegedly more benign, and is simply basically the transition effect to the year-on-year new figure. But I don't think that there's a big challenge. The services part is a little bit more volatile. And I think that what we are likely to see is a stabilization in the level of services inflation. In any case, services inflation is very low, and below the levels where it was in September or October when the Fed was very happy to cut rates.
Well, okay, Daniel, it's always good to talk to you. Thank you again.
Thank you very much. Have a good night.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.